Welcome back to The Explainer. I am genuinely thrilled you're joining us today because we are doing a deep dive into CT Real Estate Investment Trust, or CT REIT. We're going to unpack all the data and figure out exactly what makes this company tick. Now, think of today's analysis kind of like evaluating a high-yield utility bond. We aren't hunting for explosive overnight growth here, right? Instead, we're looking to buy extreme predictability. So let's just dive right into this. So here's our roadmap for today. We're going to cover foundations and intrinsic value, a financial deep dive, our SWOT and scores, scenarios and target pricing, and then finally, the final verdict. All right, part one. Let's look at the foundation and intrinsic value. The business model here, it is honestly incredibly straightforward. CT REIT is a retail-focused landlord primarily anchored by Canadian Tire. They operate on what's called a net lease structure. And what that means is the tenants, not the REIT itself, bear the property-level expenses. We're talking maintenance, taxes, insurance, all of it. For you as an investor, this literally translates to built-in inflation protection because rising costs are just passed directly to the tenant. It's a brilliant setup for generating high margins. They lock these tenants into long-term agreements, often spanning well over a decade. And this structure has driven their revenue up to over 604 million Canadian dollars. Because they focus on necessity-based retail, things like auto, hardware, general merchandise, they're heavily insulated from that e-commerce disruption that constantly plagues apparel and luxury brands. It's a highly predictable bond-like income profile. Now, I really want to anchor your attention to a specific number, $18.52. Based on the data, this is the calculated intrinsic net asset value, or NAV, per unit. When you strip away all the market sentiment and just look purely at the equity of the assets, this is the baseline worth of a single unit of CT REIT. Let's see how that builds out across some other valuation metrics. If we value the REIT based on a funds from operations, or FFO multiple of 12x, the fair value sits at $16.20. If we use an implied yield, fair value targeting 6%, we land at $15.83. Now, you might be noticing what's missing here. You won't hear any talk about traditional PE or PEG ratios. In the REIT world, those are completely ignored because heavy depreciation totally skews traditional earnings. Instead, we rely heavily on FFO and yield. And currently, the price actually trades at a slight 4.8% discount to that $18.52 NAV we just looked at. Moving right along to Section 2, the financial deep dive. So here we have the ultimate double-edged sword of CT REIT. On one hand, we have an unmatched competitive advantage, the incredible stability, scale, and credit quality that comes from having Canadian Tire as your anchor tenant. The properties are strategically tailored specifically to them, ensuring massive tenant stickiness. But on the other hand, we see a pretty glaring risk. This is massive concentration risk. A huge portion of their revenue relies entirely on a single tenant's performance. They trade the safety of diversification for the safety of one massive, reliable partner. Simply put, if Canadian Tire ever falters, the REIT falters. Let's put some hard numbers to this business model. Profitability is exceptional. Thanks to those net leases, operating margins actually exceed 75%. Funds from operations are sitting at roughly $321 million. Over on the balance sheet, they carry $1.75 billion in debt, which is about a 72% debt-to-equity ratio. Now, that's considered quite moderate and totally manageable for a REIT, especially since their operating cash flow is a massive $457 million. And for the income seekers tuning in, the dividend payout ratio is a very healthy 77% of their adjusted funds from operations. The dividend is very well covered. Qualitatively speaking, management appears highly disciplined. They strictly control that payout ratio and execute really prudent capital allocation and acquisitions. Now, is the stock wildly mispriced? No, not really. The market seems to have it priced fairly, offering a slight margin of safety primarily due to its retail exposure. The outlook here is absolutely not for distressed value hunters. It's a stable, long-term thesis for investors who want a steady, boring income generator. To wrap up the audit, let's run through a super quick red flag scan. Declining FFO? No. Unstable debt? No. Dividend at risk? No, it's well covered. Are leases rolling over anytime soon? No, long-term leases are locked in. Are they diluting shareholders? Minimal to none. But there is that asterisk at the bottom, that high tenant concentration we talked about is ever present. Aside from that single issue, the baseline safety is exceptionally clean. All right, Section 3, SWOT and scores. When we mathematically balance out the strengths, weaknesses, opportunities, and threats, notice the heavy weighting given to the strong tenant and stable cash flow. Those both score an 8 out of 10. High margins also score an 8. But we do have to penalize them for tenant concentration, which gets a low score of 4, and retail exposure, which gets a 5. When you calculate all those weighted averages together, CT REIT arrives at a solid, respectable total score of 6.8. Drilling down a bit further, the overall risk score sits at a 4.6 out of 10. This number tells us we're looking at a moderate risk investment. And as we've established, that risk isn't coming from bad debt or poor cash flow. It is almost entirely driven by their total reliance on Canadian Tire. On the flip side, the opportunity score is a 6.5 out of 10. Listen, this is not an 8 or a 9 because CT REIT is absolutely not going to double your money overnight. A 6.5 reflects a reliable, stable income generator with modest, slow growth potential. Honestly, it's exactly what a defensive play should look like. Okay, Section 4. Let's talk scenarios and target pricing. Let's contrast the extreme scenarios based on the data. In a bull case, say funds from operations grow by 5% and the market multiple expands to 14x, the value hits somewhere between $20 and $22. In a bear case, perhaps a severe economic downturn hits retail really hard, FFO declines 10%, the multiple contracts down to 10x, and the value drops to $13 to $14. Our base case sits comfortably right in the middle. Assuming a modest 3% growth, the value hovers around $17 to $19. So what does your entry price actually need to be based on the total return you want to target over, say, a 16-year horizon? If you're perfectly happy with a 5% average annual return, you could buy in as high as $22.50. But look at how demanding a higher return drastically lowers your necessary entry price. To achieve an aggressive 10% annual return from this slow grower, you would literally have to wait for the price to drop all the way down to $14.10 just to create enough of a margin of safety. Now, let's say we target an ambitious goal of earning an average of at least 9% per year, essentially aiming for a 300% profit over time. What do you need to pay today to hit that 9% depending on how long you hold the asset? If you're holding for 5 years, a $17.20 entry works. But I really want to anchor you to the long-term, 16-year hold. To confidently achieve a 9% annualized return over that span, the math dictates an ideal buy price of $15.50. And finally, Section 5, the final verdict. Look, before you even think about buying, you absolutely must know when to sell. The data-driven exit strategy here suggests trimming your position to take profits when the price sits between $20 and $22. A full exit is recommended if the price pushes above $23, because that's where it becomes objectively overvalued, or, crucially, if the underlying fundamentals start to deteriorate. If you see Canadian Tire start closing stores en masse, that is your explicit signal to exit. Ultimately, the source material classifies CT REIT as a textbook slow grower and a core income holding. The final verdict for anyone targeting that 9% return is to hold and selectively accumulate shares when the price dips below $15.50. It's an engine for income stability for sure, but not for explosive capital appreciation. Now, remember, this explainer is strictly for informational purposes, so please always ensure you do your own due diligence before making any moves in your portfolio. And that completely wraps up our deep dive into CT REIT. It really leaves us with a critical question for your own strategy. Are you out there chasing the fleeting thrill of high-growth tech, or are you building an unshakable foundation of boring, beautiful, predictable cash flow? I absolutely love digging into these numbers with you all, so which stock or REIT should we put under the microscope next? Let us know right down in the comments, and we'll keep this learning journey going. Thanks so much for joining me on The Explainer.